In 2008, a financial crisis destroyed the American housing market. Millions of homeowners faced foreclosure. The banks that created the crisis needed capital. The government provided it, but the banks couldn't hold the mortgages they'd purchased. The mortgages were toxic. The banks needed to move them. BlackRock, an asset management company that most people had never heard of, stepped in. BlackRock managed distressed assets, not with BlackRock's money, with money from pension funds, insurance companies, and foreign governments that BlackRock managed. BlackRock managed portfolios that bought distressed mortgages between 2009 and 2012. The mortgages were worth 30 to 50 cents on the dollar. BlackRock's clients paid around 40 cents. By 2012, as the housing market stabilized, those mortgages were worth 95 cents on the dollar. The investments returned substantial profits for clients, but BlackRock captured the management fees on every dollar managed. The real transformation came in 2009 when BlackRock acquired Barclays Global Investors for $13.5 billion, bringing the iShares ETF business under its control. By 2024, BlackRock manages approximately $10.6 trillion in assets. The company is worth $200 billion. BlackRock is now the largest asset manager in the world. The company doesn't manufacture anything. It doesn't invent anything. It manages money. It makes money by taking a percentage of everything it manages. During the 2008 crisis, BlackRock positioned itself at the apex of the financial system. The company became so large that the entire financial system depends on it. This is the Gilded Archives, where the greatest fortunes are built by managing other people's assets during crises and capturing fees as those assets recover. The records show a system that started in 1988 when BlackRock was founded as a bond trading and risk management business under Blackstone Group. From day one, BlackRock was an asset manager that used proprietary risk software called Aladdin to manage bond portfolios for clients. The company built sophisticated models to measure risk. Insurance companies and pension funds hired BlackRock to manage their bond investments. By the time BlackRock went public in 1999, it already managed over $165 billion in assets. In 1994, BlackRock split from Blackstone when Larry Fink and Stephen Schwarzman disagreed over equity in hiring. At the time of the split, BlackRock was already managing $23 billion in assets. The model was sustainable and growing. Managing money was more profitable than selling software alone. Software generates revenue from a limited client base. Asset management generates revenue from all assets under management. A 0.05% fee on $100 million is $50,000. A 0.05% fee on $1 billion is $500,000. The business scaled exponentially. The architecture has 3 layers. First, scale advantage. In 2007, before the financial crisis, BlackRock managed approximately $1.3 trillion. The company employed 3,500 people. That's approximately $370 million in assets per employee. During the financial crisis, when other asset managers faced withdrawals and losses, BlackRock's scale became an advantage. BlackRock could buy distressed assets that smaller managers couldn't afford. When mortgages crashed 70%, a typical hedge fund had lost capital and couldn't buy. BlackRock had capital and bought aggressively. BlackRock's scale allowed it to absorb losses that would have destroyed smaller competitors. Second, government access. In 2008, when the financial system collapsed, the Federal Reserve needed someone to manage the toxic assets it was purchasing. The Fed chose BlackRock. The Fed paid BlackRock to manage the Maiden Lane Portfolios, toxic mortgage securities the Fed had acquired. BlackRock managed approximately $250 billion in these portfolios for fees. The Maiden Lane assets were eventually profitable. BlackRock's fees paid for the management of assets that the government had purchased. The government paid BlackRock. The taxpayers paid the government. BlackRock profited from the crisis management. Third, the fee structure. BlackRock is the leader in passive indexing and ETFs through iShares, which charge low fees, often as little as 0.03% to 0.25%. Their actual total revenue in 2024 was approximately $18 to $20 billion. The fees are extracted regardless of performance. If assets increase, fees increase. If assets decrease, fees decrease but don't disappear. The fee structure created a business model where BlackRock profited from growth and profited from crisis. During growth, assets under management increase, fees increase. During crisis, asset prices decline, creating buying opportunities. BlackRock buys at low prices. When assets recover, BlackRock profits from the recovery through increased assets under management. Fees never stop. The data reveals the consolidation with precision. While the big 3, BlackRock, Vanguard, State Street, have seen massive concentration of assets, the number of registered investment advisors and asset management firms has actually increased due to the rise of private equity, private credit, and specialized hedge funds. There are thousands of asset managers, but the big 3 dominate the passive index market. BlackRock is the largest asset manager in the world. managing $10.6 trillion. Vanguard is second with approximately $9 trillion. State Street controls approximately $4.1 trillion. The top three managers control enormous portions of the passive investment market. In 1990, the top three controlled far less. The consolidation in passive investing over 34 years was exponential. The comparison to historical consolidation reveals the mechanism. Standard Oil's consolidation required buying competing refineries and closing them. Rockefeller made the consolidated entity more profitable by eliminating competition. BlackRock's consolidation works differently. BlackRock doesn't close competitors. Smaller asset managers still exist, but they can't compete on scale in the passive index market. When a pension fund needs someone to manage $100 billion in passive index investments, only a handful of companies have that capacity. BlackRock is the largest. The consolidation is achieved through scale advantage, not through acquisition. The outcome is similar. One entity controls the largest share of the passive market. The mechanism is invisible. By 2010, BlackRock had become so large that it could influence markets through its asset purchases. When BlackRock decided to buy mortgage-backed securities, the purchases moved prices. When BlackRock decided to sell bonds, the sales moved prices. A single entity's trading decisions moved entire markets. The government noticed. Between 2014 and 2015, the Financial Stability Oversight Council, FSOC, debated labeling large asset managers like BlackRock as systemically important financial institutions. BlackRock successfully lobbied against this designation, arguing that they don't own the assets, their clients do, so they don't pose the same risk as banks. BlackRock avoided being subject to the same too large to fail capital requirements as major banks. The debate revealed BlackRock's influence. The company had become central to the financial system without the regulatory constraints applied to banks. The architect of this structure was Larry Fink, BlackRock's founder and CEO. Fink understood something that most financial executives didn't. In finance, scale creates power. Power creates access. Access creates opportunities. Fink designed BlackRock's strategy around accumulating scale, acquire smaller asset managers, accept all available business, manage money from anyone who would give it. The 2009 acquisition of Barclays Global Investors and the iShares ETF platform was transformative. By 2024, BlackRock managed money from pension funds, sovereign wealth funds, endowments, insurance companies, and retail investors. The diversification of capital sources created stability. No single client could force BlackRock to do anything. BlackRock had become too large to pressure. Every time you pay into a pension fund, you engage with this mechanism. Your pension contributions are invested in assets. The asset manager is likely BlackRock or one of the other major managers. Your pension money is deployed into stocks, bonds, and real estate through low-cost index funds. BlackRock receives management fees, often 0.05% to 0.1% for institutional passive index services. When you retire in 30 years, your pension will be paid from the returns on those assets. BlackRock will have extracted fees every year regardless of performance. If the assets doubled, BlackRock extracts 30 years of fees. If the assets stayed flat, BlackRock still extracted 30 years of fees. Your pension gets whatever is left after fees. While BlackRock's index fund fees are lower than active managers or private equity, the fee is still invisible to you. You see only the final pension amount. The infrastructure extracting fees is invisible. But there's a second layer the records reveal. BlackRock doesn't just manage your pension money. BlackRock manages money for pension funds' competitors. BlackRock manages money for the companies whose stocks are in pension funds. BlackRock manages money for the foreign governments whose currencies affect pension fund returns. BlackRock votes shares in companies. BlackRock influences corporate governance. A single entity controls the voting power of all stakeholders. The pension fund can't do anything that BlackRock opposes because BlackRock controls the votes of the opposing parties. The consolidation has created a situation where BlackRock has unified power over multiple conflicting interests. We are at stage 5 of the asset management consolidation pattern. Stage 1 was the founding of BlackRock in 1988 as a bond trading and risk management business. Stage 2 was the split from Blackstone in 1994 and going public in 1999. Stage 3 was the growth during the 2000s. Stage 4 was the transformative acquisition of Barclays Global Investors and iShares in 2009. Stage 5, where we are now, is the consolidation completion. BlackRock, Vanguard, and State Street control enormous portions of the passive investment market. The control creates power over corporate governance. Stage 6, which comes next, is the regulatory response. By 2030, regulators will acknowledge that asset manager consolidation creates systemic risk. New rules will limit how much a single manager can control. The rules will require changes to voting practices or ownership structures. The consolidation will face regulatory constraints. The 3 paths forward require acknowledging the concentration's completeness. First, accept the consolidation. Asset managers like BlackRock provide liquidity. They make markets function. Without asset managers willing to buy and hold long-term investments, financial markets would collapse. The consolidation creates efficiency. Pension funds don't need to hire 100 people to manage passive index investments. They hire BlackRock at low fees. The concentration is a feature, not a bug. Accepting this means recognizing that financial system stability requires asset manager scale. Most people would accept this trade if offered explicitly, consolidated asset management in exchange for pension system stability and low fees. Most don't realize they've made that trade. Second, resist through alternative asset management. Smaller asset managers exist. They might charge different fees or target different investments. But they can't manage $100 billion passive index portfolios at comparable fees. The scale advantage makes resistance available only to large institutions with capacity to manage themselves. Pension funds can create internal management. Most can't. The consolidation creates efficiency for institutions without scale. Third, position by understanding that asset manager power requires political stability. BlackRock's power exists because governments permit it. If governments change the rules, BlackRock's power would face constraints. Positioning means understanding which asset managers have strongest government relationships. BlackRock has exceptionally strong government relationships. By 2030, that might change. Positioning accordingly means understanding the timeline of political pressure on asset managers. The deeper protection lies in what the archives show always survives financial consolidation: direct ownership of productive assets. When asset managers consolidate, individuals and institutions that own productive businesses directly, farms, rental properties, factories, retain independence. The archives show this consistently. During the 2008 crisis, asset managers faced challenges but survived through scale. Direct owners who maintained financial stability survived independently. When asset manager power eventually faces regulatory constraints, the entities that survive independently will be those that owned productive assets directly, not those dependent on asset managers for returns. The pattern says what comes next. By 2025, political pressure on asset manager consolidation will increase. By 2028, new regulations will require large asset managers to change voting practices or face ownership constraints. By 2032, the asset management industry will have adapted to new regulatory frameworks. BlackRock will remain the largest manager, but face new constraints on its influence. The consolidation will have been partially constrained, but the mechanism that created consolidation won't have changed. Scale will still create advantage. The next crisis will drive further evolution. The cycle will repeat. You retire. Your pension is paid from decades of investments managed by BlackRock in low-cost index funds. You receive the pension. You don't see the small fees BlackRock extracted along the way. You don't see how BlackRock's voting power influenced the companies that grew your pension. You experience the pension as your savings. The consolidation worked efficiently. It made itself mostly invisible. It extracted small fees from enormous asset bases. It positioned itself at the center of the financial system. It became essential to market functioning. When the next crisis comes, when markets face challenges again, BlackRock will be there to manage assets and capture fees as markets recover. The consolidation will continue its evolution. If this pattern revealed something you'd never seen before, subscribe to the Gilded Archives. History's records reveal how financial consolidation works. BlackRock isn't unique. It's one iteration of a pattern that repeats across finance, technology, and energy. Understanding it allows you to see the pattern in the next asset manager consolidation, the next crisis that creates opportunities, the next entity that becomes essential to system functioning. The records are specific. The mechanism repeats. The outcomes are predictable. We're just watching it unfold.